What's up, everybody? October is here, and that means it's once again time for me to present two deep value stocks for October. We do this every month, and I try to present some companies that are new, a little fresh, maybe a little bit different than what you see on other investing channels. I'm searching for stocks that I think might be deeply undervalued, not just a little bit undervalued. If you follow the channel, you know that I have a position in Google and Amazon, which are both very high quality companies that I think are reasonably priced. But here in this series, I want to share deep value opportunities, and often with a company I would consider deep value, there's normally something about it that many investors will not like. There's a reason why the price is so low, why the valuation is so cheap on some of these companies. And it's because there are issues. The first company has higher debt, it's in a hated industry, but it has a 50% free cash flow yield. How many companies do you know with a 50% free cash flow yield? So I hope you don't skip this video because I'm not talking about Microsoft or Adobe or a company that you're familiar with. These stocks won't be for everyone, and that's fine. I'm not recommending anyone to buy these stocks. I'm just giving you my opinion, and I hope you get something out of it. So if you get value from the video, subscribe to the channel. If you want, consider supporting me on Patreon. And now let's get into the first company. I have not talked about this company on the channel before, although I do have a very small position here. It's a fraction of 1% of my portfolio. So as I said, very small position. But you may know that recently I made a couple videos on opportunities I see in small upstream oil producers. Several of these companies are trading for 3 to 4 times free cash flow, just dirt cheap multiples. And when I was looking at the oil industry, I also started looking at oil field service companies, and that brings us to Ensign Energy. This is a fairly simple business. They own oil rigs and they drill wells, mostly in North America. About half of their revenue is in the US, roughly 30% in Canada. It is a Canadian company, so all the numbers that you see in here, they are in Canadian dollars. Now, in case you're wondering what's been going on with the stock, it really doesn't paint a very pretty picture. Oil prices were very high 15 to 20 years ago. Drilling companies like Ensign Energy were doing very well. But then oil prices collapsed almost 10 years ago. Demand for drillers went down a ton. They took on a fairly significant amount of debt in 2018 to buy up a bunch of rigs, and then COVID hit, and this was just a double whammy for them. The stock went to the gutter. They were essentially being priced for bankruptcy at this point, and even though the stock is up significantly from those COVID lows, I think it deserves to be up way more. In US dollars, this is a $330 million company, and given their market cap, they are churning out an absolutely ridiculous amount of free cash flow. $180 million over the past 12 months, more than 50% of their market cap. We'll get into what we can expect going forward and, some red flags here, but I just want to entice you with some of those, juicy free cash flow numbers. They have a bunch of rigs in Canada, actually more rigs in Canada than in the US, but these are mostly lower spec rigs. The rigs in the US are kind of high spec. That's kind of what's required for drilling in these shale rock formations in Texas, in the Permian Basin, the Eagle Ford. In terms of market share, they are the number 2 player here, right behind Precision Drilling. And you don't have a ton of new supply of rigs coming online. I don't think drilling for oil is going away anytime soon, for better or worse. So if you want to drill a well, you got to contract with, Precision Drilling or Ensign Energy, one of these companies. They do have some nice looking graphs here for revenue, free cash flow, showing that it's going up and to the right. However, what they're not telling you here is that actually revenue crashed going into 2020. So, this might be a more fair chart right here. You see in 2019 to 2020, obviously revenue dropped a ton when we went into COVID. Demand for oil dropped massively, and also demand for oil drilling similarly went way down. Even still, free cash flow was acceptable during this period, but here's what I like about this company. In hindsight, they made a mistake in 2018 when they bought up a bunch of rigs, took on a bunch of debt, but they have been razor focused in recent years on paying down debt. This is where their free cash flow is going, getting this debt down. Their interest expense now is roughly cut in half from where it was just a couple years ago. Removing this expense is not only going to help their free cash flow, but also it makes the company less risky. Part of what might be a turnoff to some investors for a company like this is looking at them and seeing, they have about $700 million US in debt on the books. They're not putting any cash towards a dividend, towards buying back shares, towards any type of shareholder returns until they get the debt below a level that they find acceptable, which management is saying is about 600 million Canadian dollars. At the rate they're going, they're probably only 2 years away from that. And once they hit that level, if they take the free cash flow that they are giving towards debt reduction right now, and if they pay that back to shareholders in the form of a dividend, you'd be looking at like a 40-50% dividend at current levels. Now, I'm not saying that's going to happen, but if they continue this trajectory with their debt and they keep chugging along and they say, now we're going to start returning capital to shareholders, that would be an enormous catalyst for this stock. Here we see they have a significant amount of forward contracting for their rigs, almost $1 billion Canadian dollars. This is up. So I think demand is going to be decent going forward. I'm expecting it to pull back a little bit from the levels we've seen in 2023, 2024. Oil prices have come down, and as they come down, that lowers the demand for drillers. This is a very cyclical industry, so from year to year, depending on what the market looks like, earnings, cash flow, revenue, they can jump up and down quite a bit. But I think a reasonable average free cash flow to expect over the cycle here is, conservatively $130, $140 million Canadian, or at least 100 million USD. Now, the reason I think the market is discounting this company so much, the reason that this company is so cheap is a few reasons. First of all, it's an oil driller. Ooh, gross. Who wants to invest in that, especially with oil prices where they are right now? Also, it's not traded on a major US exchange, so you either have to buy this over the counter, or for me, I would have to buy this on the Toronto Stock Exchange to have enough liquidity to enter a decently sized position. But probably the main reason the market is discounting this is, it says trading at, 3 times forward cash flow. But where are the earnings? The GAAP net income, the GAAP operating income, they are not here. Net income basically zero, actually slightly negative over the past 12 months. Operating income pretty weak. So a lot of people would see this and move on. Now, I always say there's no one metric that can tell you whether a stock is a buy. Whether you're looking at free cash flow yield or the PEG ratio or enterprise value to operating income, whatever it is, any metric is just telling you one piece of the story. Some people have hard and fast rules, like the revenue growth must be over this percentage or the net margin must be, this high. And if that works for you, that's totally fine. For me, my North Star is just amazing risk reward. How we get there, how we find companies with incredible risk reward, I'm rather flexible on. And frankly, if you are looking at dirt cheap companies, companies trading for like 3 times free cash flow, there's likely going to be something about that company that doesn't neatly check off all the boxes on a checklist. When I'm looking at the full picture for this business, the reason why the accounting net income is low is because of this line item here, depreciation and amortization. It's absolutely massive. $250 million USD. I mean, this is getting close to the market cap of the company that they are taking as a non-cash expense, simply because they just have a massive amount of property, plant, and equipment. These rigs that they have, they're depreciating them on their books every year. They're taking that as a massive expense. When you look at the cash flow statement and you look at what's been going on with the debt on the balance sheet for this company over the past 5 years, you see what's been happening. Over this period where they have been reporting negative net income, they have been massively paying down debt. On a cash flow basis, they've actually been very profitable, and they've been using that to significantly de-lever the business. We see the real effects of their profitability in their debt reduction. Now, valuing a company like this is a bit of a mess. I'm actually going to do something different than what I normally do to value this company. I think a little over $100 million in free cash flow is reasonably conservative for what this company can do going forward, and I'm going to assume that they take all this free cash flow and they use it to pay down debt. So this number here, I'm just going to say minus the sum of all these free cash flows. They're using this number to pay down debt. And as they pay down more and more debt, their interest rate is going to go down, and that's going to increase this free cash flow number over time. Going to assume a slight increase here from that effect. And I want to make sure I'm not double counting their free cash flow once in the debt reduction and then also in our IRR. And instead of valuing this company on a multiple of operating income, I'm just going to value them on a multiple of their free cash flow. Once they've brought their debt down to such a low level, I think 6-7 times free cash flow would be fair in that scenario. And if we change this to maybe, 6 times free cash flow, you're looking at a 17% annualized return on this company today, which on a total return basis, you're looking at, a little more than a double. And I think my numbers here are quite conservative. These free cash flow numbers, even after they increase over a few years as they pay down debt, they're lower than the free cash flow that they have now. We're not assuming any growth. I'm not assuming any of this free cash flow comes back to us directly in these 5 years. It goes to pay down debt. And I'm only giving them a multiple of 6 on that free cash flow for what would be a low debt company at that point. Obviously, they could massively outperform these numbers. As far as what the downside is here, I think just as they become less levered, the net asset value of all these rigs that they own gives a reasonable amount of cushion. The amount that someone would have to pay to replace these assets is way more than their market cap. Another way to think about this is more in the vibe of, maybe a Monish Pabrai who talks about how he likes companies where he doesn't need to use a spreadsheet at all. The value proposition is just clear. And that's, after they pay down a couple more years of debt, management will likely start returning capital to shareholders. And if you think a little bit over $100 million USD is a conservative estimate of what free cash flow will be, you're looking at roughly a 33% owner's yield in just a couple of years. So that's my thesis on Ensign Energy. Again, won't be for everyone. That's totally fine. Now let's move on to the second stock, and it's another one that I have not talked about before on this channel. And this is gambling.com, ticker symbol GAMB. Another one where it's not a pretty picture. Year to date, down 40% over 4 years because the company's only been public for about 4 years, basically flat. They're essentially trading for their IPO price. This is only a $300 million company, and they have grown rapidly in recent years. Revenue has really skyrocketed, and they've done this while maintaining profitability. They are trading for close to a 10% free cash flow yield, and I always adjust free cash flow for share-based compensation, so I'm already deducting that out to get to this number. Now, how does this company make money? There's basically two main lines of business here. They own and run a bunch of websites, gambling.com, casinos.com, RotoWire. These websites have news, stories, deals, all sorts of things. And casinos, operators, they advertise on these websites. We see some of their clients here, DraftKings, FanDuel, World Series of Poker, Party Casino. These are relatively big names in the space. And if someone goes from one of these websites to an operator, then this company gets a cut. They're either getting a flat fee or they're getting a percent of the money that customer brings into the operator, or maybe some hybrid model. So this is currently the core business. This is about 75% of their top line. And this business has been growing really well. 2025, they're guiding for excellent growth here. This bar, that's just the first half of 2025. Now, much of this growth they have done through acquisitions, so this growth rate is not organic. They do have now around $80 billion of net debt on their books. Given where their cash flow is at, I think that this is totally reasonable. It looks like to me they've made some great deals and they do a very good job of monetizing their assets. What I'm also excited about is the other 25% of this business is essentially a subscription service. Customers subscribe on OddsJam and RotoWire to get odds data, basically insights and analytics. And subscription revenue is very sticky. This is also high margin and I would consider much more predictable. And this segment has been growing faster than their core business. As this makes up a larger share of the company, I think the market will recognize that this is not just a marketing business. This is not just an advertising funnel. This is also a software as a service company. Furthermore, while they're not directly involved in gambling, this is not a gambling operator. I think they are going to benefit from the massive tailwind that is the shift to online gambling. Over the past couple decades, online gambling's share of total gambling in Europe has grown from essentially nothing, 3%, to now in the high 30%. But in the US, online gambling still only makes up a single-digit percentage. It's very low. Every state has their own rules, but more and more states have measures that will legalize online gambling to some degree. Online sports betting, for example, in Missouri is going to be legal at the end of this year. And I think if this company just rides the wave, they don't really have to do anything special to have excellent growth going forward. I think the market is just overlooking this company, and I think we are being offered a pretty good opportunity today. My base case assumptions, I think, are quite conservative. I'm only assuming 10% revenue growth going forward, and I think operating margins are likely to expand as this company scales. It's a relatively asset-light business. But I'm actually assuming operating margins just remain roughly where they are today at 25%. This trailing 12-month number of 10% operating margins includes about a $20 million expense for an earnout from their acquisitions. That's a one-time thing. Free cash flow margin, I'm keeping this very low. The company is currently buying back some stock, but I'm assuming some cash flow will have to go towards other acquisitions and also paying down some of the debt. So I'm not taking into account a lot of money coming back to us shareholders. And at the end of the day, for an asset-light business like this, growing 10%, a 12 times multiple doesn't seem demanding at all. And in this scenario, you are looking at a 19% annualized return on this stock. This is more than a double in 5 years on what I think are very conservative assumptions. In my bear case, I'm only going to assume 5% revenue growth, just barely over inflation. Essentially, this growth story that we've seen, it basically stagnates, it stops, operating margins are going to compress. And I'm only going to give them an 8 times multiple. And in this scenario, yeah, you're roughly flat on your money, down a little bit, down, 12% on your money over 5 years. This obviously wouldn't be great, but for a pessimistic bear case, it really isn't all that bad. And as far as what the upside is here, I'm only giving them 15% revenue growth, which is still a lot less than what they have done recently. I'm giving them a very slight expansion in operating margins, really not much though, and a bit more credit for free cash flow that can come back to shareholders. For a company like this, I really think a 16 times multiple is not all that high. And in this scenario, you are looking at a 38% annualized return. That is close to a 5x on your money over 5 years. investors. I think the market is just missing this one right now. I think we're being offered quite a good risk reward. There's possibly some fear that AI is going to completely change the nature of search, which is going to disrupt their core advertising business. But I think for a lot of people, for a lot of investors, a company like this just isn't on their map. And being a sin stock related to gambling, that always has the potential to give a company like this a bit of a discount. So overall, hope you got something out of this video. Hope you found some ideas that maybe you won't hear from on other channels. And if you did get value, I hope you subscribe. If you want, consider supporting me on Patreon. And if you agree or disagree with anything I said in this video, please let me know why down in the comments below. And I hope to see you all in another video.